All right, I have good news and I have bad news. Which one do you want first?
Anything sounds bad when you say it with that attitude.
All right, I'm gonna give you the bad news first.
Bring it on.
If you're looking for the YouTube video that's gonna help you pay no taxes ever, this is not it.
Why are you the way that you are?
In fact, if you have that video queued up, I'm gonna tell you it's probably not true. Now, before you leave, on to the good news. This video is gonna help you pay less in taxes, the real way, with real planning examples, and it's gonna educate you along the way. In this video, what we're gonna be talking about is capital gains taxes. It's one of the biggest things I see out there as an opportunity set for people that are earning money to figure out how to invest it in a way that they can earn more money in the future and keep more money in their pocket. So if you're into that sort of thing, you should stick with us. Hey everyone, if we haven't met before, my name is Jacob Turner. I'm a former Major League Baseball player and certified financial planner and the co-founder of Moment Private Wealth, a financial planning firm that specifically helps athletes and entrepreneurs build and protect wealth. And as I mentioned, this video is going to be all about capital gains taxes. And the way that we're going to break this down is really into 4 sections. Section 1 is what is capital gains taxes? You're going to better understand what they even are in the first place. Section number 2 is we're going to learn about how they're taxed. And this is why it's so important to understand this is they're not taxed at ordinary income rates. In fact, they're taxed at significantly lower rates. Number 3, we're going to talk about how do we get money in those significantly lower rates that we just talked about. And number 4, I'm going to show you a real tax planning example. And the reason why that's so valuable and why you need to make sure you stay till the end is because our business at Moment Private Wealth is all about making sure that clients, athletes, and entrepreneurs that have bet on themselves are maximizing their opportunity set. I'm going to show you what this looks like in a real tax planning example. Now, if you're out there and you're watching this video and this is your first time around here, my goal is to help you get smarter with your money. So if you're into that sort of thing, make sure you subscribe. I'd really appreciate it. So let's talk a little bit about capital gains. What are capital gains in the first place? Well, said simply, capital gains is that delta, that in between of the investment that you make and the upside that it has. So let's say we buy Apple stock and we bought it for $50. We held on for a couple of years and now it's worth $100. That $50 in between, what we would call the delta, that's the capital gains. So if we sold that stock, we had $100, what would we pay? Is it ordinary income? Is it capital gains? What's the percentage? Well, see, and that's what I'm going to help you talk about today. I'm going to help you learn how to pay less and keep more money in your pocket. But capital gains, said real simply, is any investment that you make. This is not earned income. This is not money you're earning from your job, but this can be things like real estate. This can be things like stocks. This can be things like businesses where you have an asset. You're selling that asset. It gets taxed at capital gains. So let's talk about what are capital gains tax rates and how they're taxed. And to understand this, I think we need to first understand what are ordinary income tax rates. So what I'm showing you right here is this is the 2026 tax brackets for if you are married filing jointly. Now, if you're new to this whole tax game, go back and watch a previous video I did on how income taxes work. It is a good foundational primer before you watch this video. But what you need to understand is ordinary income taxes go like this. They go from the 10% bracket to the 12, all the way up to the 37% bracket. And what you can see here is depending on what your level of income is, once you fill up that initial bucket, you go to the next bucket. Now, you need to understand what your filing status is. So again, if you're new to taxes, good news, I have another video for you. It's on how income taxes work. Go watch it. So now that we understand how ordinary income taxes are, let's talk about capital gains taxes and why they're so valuable. Well, before we even talk about the numbers, I want you to understand something. You can have an asset, an investment you made, get taxed as long-term capital gains and short-term capital gains. Now you're probably thinking, okay, well, what's the difference between that? Long-term capital gains means it actually gets taxed at capital gains tax rates. That's what we want. Short-term capital gains means it gets taxed at ordinary income rates, what I just showed you. So in reality, short-term capital gains is just like ordinary income. Think about it the exact same way. Now, I want to talk about what the long-term capital gains rates are. That means if we held an investment for more than a year, it gets taxed as long-term capital gains. And what I'm showing you here is these are the 2026 brackets for capital gains taxes. Now, you can see on the left-hand side, we have our filing status, and then we have the maximum rate at 0%. Now, I did tell you at the beginning of this video that there's no way around paying taxes and that this wasn't the video for you. But in fact, I am going to show you a way that you can pay 0% income taxes. It's called long-term capital gains and you have to make a certain amount of money. But at the end of this video, I'm going to show you in that example how to actually do this. So what you can see here is the maximum 0% rate if you're single, if you're married filing jointly, and everything in between. You can also see the maximum 15% rate. Now, some of you out there might be thinking, especially you CPAs if you're watching this video,
Well, Jacob, there's other brackets. There's other things you're going to pay in capital.
I know. Let me get to it. So what I'm showing you is the 0% and the 15% bracket. There's also a 20% bracket. So think about it like this. Federal long-term capital gains 0%, 15, or 20. You're going to pay one of those three. You can pay a mix of those three. This is not a cliff. It works just like ordinary income. You're going to fill up each individual bucket before you go to the next bucket. You're also going to pay state income taxes on capital gains depending on the state that you live. What I'm showing you here is 2024 numbers on state income taxes. This is why it's important to make sure you have somebody on your financial team that's keeping you updated on these tax numbers. These are 2024. What changed in 2025? Well, I live in Missouri. We used to pay 5% on capital gains taxes in the state of Missouri. Not anymore. That changed in the most recent tax changes. These are why you want to make sure that you have somebody on your team that's constantly looking at your situation, just like we do at Moment, to make sure that you are maximizing the opportunity set that you have. If you're in one of these states where you have capital gains taxes, you need to add that onto either your 0, your 15, or 20% rate. And then you're also going to add in something called net investment income tax if you make a lot of money. This slide shows you what net investment income tax is. It works like this. If you are a single filer, you make more than $200,000 a year, any capital gains you have, those long-term capital gains, you're going to tack on another 3.8%. If you are married filing jointly, you make more than $250,000, you're going to tack on another 3.8%. It's essentially the government's way of saying, hey, look, you're making a lot of money. I want to make sure you pay your fair share of taxes. So here's what you need to understand about how capital gains taxes work. Number one, to get long-term capital gains treatment, which is what we are talking about specifically in this video, you need to hold that asset for more than a year. Number two, on the federal side, it's either 0, 15, or 20%. You're also going to potentially pay state income taxes depending on your state. Check your own situation. And you might pay net investment income tax if you're making a lot of money. But even if you do all of those things, you pay the 20% rate, you pay your state income taxes, and you pay net investment income taxes, you are still going to be coming out drastically ahead of 37% bracket, 35% bracket just on federal taxes alone. And this is why we want to make sure that if we can, we are getting as much money as we possibly can taxed as capital gains and not ordinary income. So let's talk about that. How do we get money that's taxed as ordinary income into these capital gains brackets? Because this is what we really want. Well, said simply, you need to invest your money for the long term. You need to take money that you are earning from your job and invest it in a way to make sure that you understand that it could potentially be taxed as long-term capital gains in the future. Now, I'm going to give you an example of a huge mistake that I see with a lot of high earners that we work with. They make money from their job. Maybe it's a business, maybe they're an athlete, maybe it's a contract. They have an opportunity come to them, an investment that they say, it's going to pay me 10, 12, 15% a year, but it might get taxed all as ordinary income. An example might be hard money lending. It sounds great on the surface, but the reality is all that money, that 10, 12, 15% that's coming into income, that mailbox money, it's getting taxed as ordinary income. So you need to understand how your different investments are taxed in the first place. Heck, you need to make sure that you are investing for the long term, because remember, if you don't hold the asset for more than 12 months, it's going to get taxed as short-term capital gains, which is basically the same as ordinary income anyways. So how do we do this? We want to make sure that we are taking the money that we have from the job that we have and investing in long-term assets. We need to understand how they're structured. We need to make sure we're in it for the long run. It might sound simple, but I'm telling you right now, as you make more money, as you have more opportunities come to you, I see this all the time. People start dabbling in all these different things and they forget that the most basic idea is we need to make sure that we're in it for the long haul. So we're going to hold that asset for longer than 12 months. And we need to make sure we understand how that asset is structured, because I want to make sure every investment that I make is taxed as capital gains. I think about the entrepreneurs that we work with. I think about when they're selling a business, one of the biggest tax planning moves that we can make, the thing that we help them with the most, is how do we structure the sale of that business? I want to make sure that every dollar that comes in from the sale of the business is going to get taxed as capital gains. Because remember, even if you're in the top bracket, the 20% bracket, even if you pay that net investment income tax, you're only at 23.8%. It's a heck of a lot better than 37% just on the federal income tax side alone. I promise you I'd talk about an example of how this works. Heck, I promise you I'd show you how to pay 0% capital gains taxes. So here's how you're going to do it. Let's say you have $95,000 in total income. Say $50,000 of it's ordinary income. Now, before you say, well, Jacob, I earn way more than that, so this example does not apply to me. It still could apply to you, because I think about a lot of the athletes, a lot of the entrepreneurs we work with, they have millions of dollars. They've had years where they made $10 million, but not every single year they're going to do that. Heck, if you're an entrepreneur and you sell a business, the year after that, you might have a lot lower ordinary income. If you're an athlete and you're coming out of playing and you're going into your next career, you might have a lot lower ordinary income. This is a huge opportunity to take advantage of these capital gains tax rates. And this is why I always preach that tax planning is a lifetime game. If you're thinking about taxes on a yearly basis, I assure you, you are missing the boat. You need to think about your taxes as this lifetime game and how can you chip away at it each year. Sometimes that might mean prepaying taxes. Sometimes it might be strategizing around capital gains. But in this scenario, we made $50,000 of ordinary income. We had $45,000 of capital gains. So how does this get taxed? Well, on the 50,000 of ordinary income, the first 24,800 gets taxed at the 10% bracket. Okay, pretty good. The next bit of that gets taxed at the 12% bracket. So our total 50,000 ordinary income split between the 10 and the 12% bracket. Let's just call 11% for averages. Now let's talk about that other $45,000 of capital gains. How's that going to get taxed? A big fat zero. No taxes. Now, why is that? Well, let's go back to our previous slide on capital gains. What you can see here is the top bracket, married filing jointly, of the 0% rate, 98,900. What that means is we made 95,000. So we are below that top rate, which means that any capital gains we had up to 98,900 total income, 0% taxes. That is incredible. That is absolutely incredible. This person could have millions of dollars invested, but if they only have that much in capital gains and that much in ordinary income, 0% taxes. And this is why I preach so much. You need to understand how the tax code works. We do not get to make the rules of the game. The IRS gets to do that. We do get to choose how we're going to play the game. And I see too many times, people are incredible at making money. The entrepreneurs that we work with, the average entrepreneur is worth more than $10 million. They are extremely smart people. But sometimes even the smallest details, things like capital gains, can get in the way of them making sure that they're maximizing their opportunity set. And that's what we're here for. I want to make sure that everybody that's betting on themselves out there, frankly, is making sure that they end up with the most money in their pocket that they possibly can. As always, my goal is to help you get smarter with your money. So if you're into that sort of thing, make sure you follow along. Until next time, my friends.